What is an initial public offering or IPO?
Yeah. So, yeah, and Palm Ledger brought up that there's a pre-IPO, IPO, and post-IPO. You've stolen the second slide of my pitch deck. But you're welcome to it. Yeah. So but when a company is born, so to speak, when it's an idea in somebody's head, they go out and they find their friends and family, and they do what's called pre-seed, and they raise, I don't know, $50,000, $100,000, whatever they can, to try to get enough people in to have a proof of concept, or not a proof of concept, have an idea that they think can actually work, and then they go out and they get angel investing, and then the angel investors come in, they give them seed money. Could be $1 million, could be $500,000, and then the company starts growing a little bit, and they start having something that's maybe close to going to market, and so then they get their A round of funding. A round of funding I've seen A rounds at $50 million. Most A rounds are well below that. Then once they have like a prototype, typically they'll end up in that B round where they can actually start selling things, and then they may start getting some revenue in. They go to the C round because now they actually have a concept that's actually working and maybe is selling. So it goes through C, D, E, and they keep growing and they keep getting more cash. But eventually, the investors who's put all this money in from pre-seed all the way up to that D or E round, they want to get out. They want to have their liquidity event, because they have a lot of capital tied up in there. And then the people who started, obviously, they have a lot of stock as well, and they've a lot of times the first few years you don't get paid at all, and then even later on, most of your compensation is still tied up in this company. So a company has a few choices when it wants to have that liquidity, right? When it wants to either raise, well, it's going to raise more money because it's going to sell some shares. It's going to give their stockholders additional liquidity. They can be acquired, which is one way of doing it. They can do a SPAC, which was in the news a lot, probably about a year back. It was pretty popular. We can talk more about that if you want. And then they'll merge in. That's it. Well, that's an acquisition. They'll go direct listing. So that means they just sort of say, hey, world, these are our shares. Go ahead and buy them. Or they'll go an IPO route. And an IPO is that initial public offering, is done through a series of banks, and those banks, help finance the actual mechanics of the offering. They get they're called syndicates. They get their kind of their larger clients have an opportunity to pre-buy the shares at an IPO price, which is set by the syndicates. And then once that IPO is supposed to happen, it's an IPO date. They ring the bell. You'll often see the pictures of whoever's turn it is on that day to ring the bell. They have gone public on that day, and at that point, there's liquidity for some people, not everyone. Which is sort of the interesting part of it, and for people who are early shareholders or their employees, there's oftentimes restrictions on the shares. So that means they can't sell right away, or maybe they're limited in their sales, which is a little more popular nowadays. But either way, they can't just sell the whole kit and caboodle on that day. Most people actually don't want to, but either way, they usually it's a 6-month lockup period. So before 6 months, they can't sell the whole thing. They're either limited or they can't sell at all. And so once that 6 months is up, now they can sell if they don't have insider information that's material. So again, there's all these caveats and restrictions that go into the IPO process for someone who's just who's been with the company for 5 years and has a bunch of shares. But that IPO process takes a while. So from pre-seed to IPO, you could be looking at 7 to 10 years, perhaps. Companies are holding out longer to go public, because when you go public, all of a sudden you're subject to a board that has duties to the SEC. The SEC wants to see 10Ks. They want to see all these disclosures. It's a different world, and you become responsible to more shareholders. And it's a lot of places are trying to not go public as long as they can, but eventually those investors, they want their money. So yeah, and that's an IPO process in the nutshell. We can go into the nuts and bolts, and it's fascinating, but